You check your investment account on a Tuesday morning. The market's been choppy. Your portfolio is down 3% from last month. You feel that familiar tightness in your chest. You open your brokerage app, stare at the red numbers, and then you close it. You tell yourself you'll look again next week. And here's what you don't realize in that moment. Your financial advisor just made money off that decision. Not because they sold you something. Not because they charged you a fee. But because you did absolutely nothing. Doing nothing with your money is one of the most profitable decisions you can make. Just not for you. I'm Adam. I spend an unreasonable amount of time thinking about money, investing, and the mistakes people keep making with it. And if you've ever felt stuck, confused, or slightly uneasy about your financial decisions, this video is for you. Because there's a trillion-dollar industry built on a simple truth that nobody wants to say out loud. The less you do with your money, the more profitable you become to manage. Not profitable for you, profitable for them. This isn't a conspiracy. It's incentives doing exactly what incentives always do. And the fascinating part isn't that this happens. It's how perfectly the system is structured to make you think doing nothing is the smart choice. Let's start with what most people believe about investing. You've been told to think long-term. You've heard Warren Buffett say his favorite holding period is forever. You've read that time in the market beats timing the market. And all of that is technically true. But there's a version of this advice that gets weaponized in a way most investors never notice. It's the difference between strategic patience and profitable paralysis. And financial companies have spent decades blurring that line. Here's how it works in practice. You have $50,000 in a managed portfolio. You're paying 1% annually in fees. That's $500 a year. Seems reasonable. You're busy. You don't want to think about it. The account just sits there quarter after quarter doing what it does. Some months it's up. Some months it's down. But you're a long-term investor, so you don't touch it. You don't ask questions. You don't compare alternatives. You just let it run. And here's what happens over 20 years at that 1% fee. You don't just pay $10,000 in fees. Because fees compound against you the same way returns compound for you. The actual cost, accounting for lost growth, is closer to $30,000. Maybe more, depending on returns. Now, that number alone isn't the problem. Management costs money. Research costs money. Someone has to do the work. The problem is what happens when you realize most of that portfolio hasn't changed in 5 years. Same stocks. Same allocation. Same strategy. The work stopped happening years ago, but the fee kept running. And nobody told you to check. In fact, you were actively encouraged not to. Here's the part nobody tells you. There's a concept in behavioral finance called status quo bias. It's the human tendency to stick with the default option, even when better choices exist. We do this with phone plans. We do this with subscriptions. And we absolutely do this with investment accounts. Researchers have found that people will stay in underperforming funds for years, even when switching costs nothing, simply because switching requires a decision. And decisions require energy. The financial industry knows this. They've studied it, and they've built entire business models around it. Consider what happens when a company launches a new fund. They market it aggressively. They tout the strategy. They publish white papers. They get you to move your money in. And then, once you're in, the marketing stops. Not because the fund is performing well. Not because you're happy. But because you're stationary. And stationary clients are the most profitable clients in finance. They don't call. They don't complain. They don't leave. They just pay fees year after year, while the company shifts its resources to attracting the next batch of clients. You might be thinking, but my advisor checks in with me. We have annual reviews. And that's true. But pay attention to what those reviews actually cover. They'll show you performance. They'll rebalance if you're off target. They might adjust your risk tolerance as you age. But here's what they almost never do. They don't compare your fees to cheaper alternatives. They don't question whether active management is worth it when you're in index tracking funds. They don't suggest you could do this yourself for a tenth of the cost. Because the review isn't structured to optimize your outcome. is structured to retain your assets. Let's put real numbers to this. Say you have $200,000 invested. Option 1, you're in a managed account paying 1.2% annually. Over 30 years, assuming 7% average returns, you'd end up with about $1.2 million. Option 2, you move to low-cost index funds charging 0.1% annually. Same returns, same time frame. You'd end up with about $1.6 million. Not because markets guarantee this, but because most active managers fail to outperform after fees over long periods. That's a $400,000 difference. Not from performance. Not from skill. Just from the decision to stop paying someone to do nothing. But here's the uncomfortable part. Even after seeing those numbers, most people still won't move. Because moving requires admitting you've been overpaying. It requires learning something new. It requires taking responsibility. And the human brain will do remarkable things to avoid feeling foolish. So instead, we rationalize. We tell ourselves the advisor provides value in other ways. We convince ourselves that we're not smart enough to do it alone. We imagine disaster scenarios where we panic sell at the worst time and lose everything. And the industry reinforces every single one of those fears. This is why financial companies spend so much money on brand trust and so little on actual innovation. They don't need better products. They need you to feel like leaving would be reckless. They need you to associate doing nothing with being responsible. And it works. The average investor stays with the same advisor for over a decade, even when performance lags, even when fees creep up, even when better options exist everywhere around them. This is where the math stops matching. When you don't touch your account, the company managing it can forecast exactly how much revenue you'll generate next quarter. They can model it 5 years out. They can borrow against it. They can sell that predictable income stream to investors. Think of your investment account like a subscription you forgot to cancel, except it scales as your balance grows. You're not just a client. You're collateral. And once you see it, you can't unsee it. The system is structured in a way that rewards staying put. Switching brokerage accounts is intentionally tedious. Forms need signatures. Transfers take weeks. There are always warnings about tax implications, even when those implications don't apply to you. Every step creates friction. Not illegal friction. Just enough inconvenience that most people give up halfway through and decide it's not worth the hassle. Which, of course, is exactly the point. Think about how this plays out with retirement accounts. You start a job at 25. Your employer offers a 401k with a default investment option. You check the box, set your contribution, and forget about it. You change jobs 3 times over the next 15 years. Each time, you leave the old 401k where it is because rolling it over seems complicated. By 40, you have 4 separate retirement accounts, each charging different fees, each in different funds, none of them optimized, none of them coordinated. And you tell yourself you'll deal with it eventually. But eventually never comes. Because eventually requires doing something. And doing nothing is so much easier. In many cases, the real value isn't active management. It's managing behavior so assets don't leave. And the best way to do that is to make you believe that staying put is the same thing as being smart. Now flip the perspective. Loss aversion is one of the most studied biases in behavioral economics. People feel the pain of losing money about twice as strongly as they feel the pleasure of gaining it. So when you think about switching investment strategies, your brain doesn't calculate the potential upside. It fixates on what could go wrong. What if you move your money and the market crashes the next day? What if the new platform has hidden fees? What if you mess up the transfer and trigger a taxable event? None of these fears are irrational, but they're disproportionate. And the industry knows exactly how to activate them. This is why investment firms spend millions on risk disclosures and compliance language. Not to protect you, to protect themselves while simultaneously scaring you into staying still. Every prospectus is designed to be incomprehensible. Every disclosure is written to sound ominous. Because confusion breeds caution, and caution breeds inaction. And inaction is the entire business model. Let's talk about what this looks like at scale. There are trillions of dollars sitting in outdated, overpriced investment products right now. Not because those products perform well, not because investors love them, but because switching requires a decision, and decisions feel risky. The largest asset managers in the world aren't competing on performance anymore. They're competing on stickiness. How long can they keep you from leaving? How many psychological barriers can they place between you and the exit? And it works differently depending on how much money you have. If you're managing $50,000, you might not think it's worth the effort to save a few $100s a year in fees. If you're managing $5 million, you assume you need sophisticated help and complex strategies. Both assumptions make you stay. Both assumptions make someone else rich. You might be thinking, okay, but some people really do need advice, and that's fair. But here's the question nobody asks. How much of that advice is actually advice, and how much is just expensive permission to do what you already know you should do? Most financial plans boil down to the same basic steps. Spend less than you earn. Invest the difference in diversified, low-cost funds. Don't panic when the market drops. Adjust as you age. That's it. You don't need someone charging you 1% of your assets every year to tell you that. But you might need someone to make you feel okay about doing it. And that feeling is what you're actually paying for. The most profitable client in finance isn't the one with the most money. It's the one who never asks questions. The one who assumes complexity where none exists. The one who conflates activity with value. Because once you start asking questions, the whole thing falls apart. Why am I paying this much? What am I actually getting? Could I do this myself? Those three questions are the beginning of the end for the traditional model. Which is why the industry works so hard to make sure you never ask them. Here's what makes this entire system so quietly brilliant. It's not fraud. It's not even unethical by most legal standards. It's just capitalism finding the path of least resistance. And the path of least resistance runs straight through human psychology. We don't want to think about money. We don't want to feel stupid. We don't want to make mistakes. So we outsource the responsibility and then never check back in. And every year that goes by, the cost of that outsourcing compounds. Not just in fees, but in opportunity cost. In knowledge you never gained. In confidence you never built. The people who benefit from this aren't evil. They're not scheming in boardrooms about how to rob you. They're just running businesses that profit from inertia. And inertia is the most reliable force in personal finance. More reliable than greed. More reliable than fear. Because inertia doesn't require you to do anything. It just requires you to keep not doing anything. Forever. So here's the uncomfortable question you probably haven't asked yourself. How many of your financial decisions are actually decisions, and how many are just defaults you never questioned? That brokerage account you opened 10 years ago. That advisor you hired because a friend recommended them. That allocation you set and forgot. How much of your financial life is running on autopilot, generating fees for someone else, while you tell yourself you're being responsible by not interfering? And here's the thing that should bother you. The system is structured so that the answer to that question doesn't matter. Because even if you realize right now that you've been overpaying for years, what are you actually going to do about it? Are you going to spend this weekend researching alternatives? Are you going to call your advisor and ask uncomfortable questions? Or are you going to close this video, feel vaguely unsettled for a few hours, and then do exactly what you've always done? Which is nothing. The moment you start asking questions, the system stops working. And whether you ask them or not, that's the only decision that actually matters.